Are you sure the money in your bank is really yours? In 2025, that's not so obvious anymore. Inflation eats away at savings, banks are shutting down, and public trust is crumbling. While you believe your money is safe, in reality, it's working for the bank, fueling their investments, while you get only pennies in interest. So, today we'll break down what actually happens to your money once you put it in the bank, how secure it really is, and what alternatives you have if you don't want to wake up one day with an empty balance. Most people have no idea how fragile the system really is. Let's fix that. Part number 1. How banks use your money. When you put money in the bank, it's not sitting in a vault with your name on it. Nope, the bank immediately puts that money to work. They loan it out to other people, to businesses, or invest it in different ways. So why do they pay you interest? Because, technically, you're lending the bank your money. But here's the deal. You get a tiny cut, while the bank makes way more, since lending rates are always higher than savings rates. That difference? Pure profit for the bank. Sounds fair enough, right? Your money feels safe. The bank uses it. Everybody wins. But here's the catch. If the bank makes too many bad loans, if too many customers try to pull their cash out at once, or if the economy takes a hit, it's depositors who pay the price. And that's when you have to ask yourself, how safe is your money really? Part number 2. What protects depositors? Banks don't run without a safety net. Otherwise, every crisis would turn into total chaos. That's why most developed countries have deposit insurance. Basically, even if your bank fails, you'll still get your money back, at least up to a certain limit. The idea is simple. Small depositors are almost always safe. If you've got just a few thousand in savings, you don't really need to worry. But here's the problem. If your balance is bigger than those limits, you're exposed. No one's guaranteeing you $1 million if your bank goes under. And that's why spreading your money across different banks, or looking at alternatives, becomes so important. Part number 3. The biggest risks in 2025. Risk number 1. Inflation. Even if your money is technically safe, it's losing value. A savings account paying 2% while inflation is 5%? That's like watching 3% of your money evaporate every year. Risk number 2. Bank failures and frozen accounts. Rare, but they happen. Thousands of Americans using the Yota app couldn't access their money for weeks when accounts were frozen. And in Europe, summer 2025, customers of Credit Mutuel and CIC couldn't withdraw cash or pay with cards for hours due to a massive outage. Not an everyday event, but it shows the system isn't perfect. Risk number 3. Interest rate swings. Rates go up, rates go down, and banks get squeezed in the middle. If the swings are too sharp, banks can stumble, and that risk trickles down to depositors. And risk number 4. Digital control. More countries are pushing digital currencies and tighter regulations. For the average person, that means less privacy, more monitoring, and more limits on how you can use your own money. Safe? Maybe? Free? Not really. Part number 4. How to reduce the risks. So we've seen that keeping money in the bank isn't completely risk-free. But here's what you can do to protect yourself. Tip number 1. Diversify. Never keep all your money in one bank. If you've got more than the insured limit, spread it across different banks. Simple, boring, but effective. Tip number 2. Know the limits. In the US, FDIC covers $250,000 per person, per bank. In Europe, it's usually 100,000 euros. In the UK, about 85,000 pounds. Anything above that? It's on you if the bank goes under. Tip number 3. Keep some cash and liquid assets. A little cash at home can be a lifesaver if the banking system glitches out. And liquid investments like short-term bonds or money market funds give you stability plus quick access. And tip number 4. Look at alternatives. Solid investments, index funds, government bonds, even gold. often protect your money better than a savings account paying pennies. Bottom line? Don't put all your eggs in one basket. Banks are useful, but they're not the only option for keeping your wealth safe. Part number 5. Alternatives to banks. If banks aren't the only answer, what else is out there? Let's talk about some real alternatives. First, government bonds and money market funds. These are almost as safe as a savings account, but usually pay you more. Plus, they're liquid, meaning you can get your cash back quickly if you need it. Second, index funds. If you're looking long-term, broad market funds have historically outperformed savings accounts and beaten inflation. Yes, prices go up and down in the short run, but over time, they're one of the most reliable wealth builders. Third, safe haven assets like gold. Gold doesn't pay interest, but it shines when everything else gets shaky. It's insurance for your portfolio. And fourth, good old cash. Not glamorous, but keeping a little stash at home means you're covered if ATMs go down or systems glitch out. Here's the key. Don't pick just one. Mix them. Banks, bonds, index funds, a touch of gold, and some cash on hand. Together, they give you safety, stability, and growth. So, bottom line, in 2025, banks are still relatively safe, but only up to a point, and only as part of a bigger strategy. The real risk isn't losing your money to the bank. It's inflation and restrictions slowly eating away at its value, and your freedom. Smart money today is spread out. Some in banks, some in bonds and funds, a bit in gold, and yes, even some cash. That's how you build real financial protection that works in any situation. Start building your strategy today. Subscribe, and with Up IQ, take control of your financial future.